Well, I'm glad you found yesterday's session valuable. I appreciate the feedback. That's really cool. In any case, let's get going today. It's a Thursday, the 19th of March, 2015, 7:30 in the morning New York time. My name is Wayne McDonald. I'm the Chief FX Market Strategist for TradersWay.com. Thank you for being a client and attending today's free session. So yesterday we had FOMC day, and we discussed how we had looked at the data and thought that there was no way in hell that they were going to adjust interest rates anytime soon, and that the market was likely mispriced, that a lot of people had anticipated interest rates being raised in June, maybe even April. They've been thinking this for a long time, which means they're very, very dollar bullish, because an increase in interest rates raises the value. So they've been buying all these dollars, and they're just, well, wrong on the timing. I don't think I've wavered in, I don't know, 2 years of the analysis of the Fed, right? So anyway, so we had discussed yesterday and the day before and the day before that there was going to be likely some dollar weakness, and that we understand why. It's not necessarily an end of a trend, but just the market being mispriced. And that they were going to have to rebalance their portfolio, right? Nothing to freak out about, right? Was that a message that you got from me? That there's no need to freak out, that it's just people rebalancing, and that on the long run, whether it's in a day or week or month, you know, eventually the prevailing trend should continue? Yeah. And sure enough, the word patient was removed. Currency pairs moved like 500 pips. And should have been a good trading day. Let's review. Now remember, trading with leverage is risky and not appropriate for everyone. Your past performance does not predict future results, good or bad. Therefore, always stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. So the game plan yesterday could have been fairly simple, depending on sort of what time frame you're looking at, you know, or coming from. Dollar weakness, not a shocker, right? Again, we had talked about it, I don't know, 72 hours in advance, maybe even last week. Fine, all right. So the Fed's not going to raise interest rates soon. People get out of their short positions, and the euro dollar goes up. It's not that people were suddenly wanting to invest in the euro. It's just that they had been shorting the euro, and they have to get out. And to offset the short position, the broker enters a long position, and the market goes up. Euro USD goes up, but it's not really people getting out of US dollars and buying euro. They're getting out of their euro short. Okay. So, anyways, markets move. Now, on a smaller time frame, you take advantage of the fact that the market's moving and that you understand why it's moving. It's offsetting. It stops being triggered. It's people panicking and getting out of short positions. So you could scalp it long, couldn't you? Let's use, I don't know, everybody likes Euro USD, right? So you got that price action going for you. Let's bring this chart up. Come on, boom, 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 boom. Lots of stuff going on. All right, fine. And here's the trade plan we set up a week and a half ago. Is that enough time for you? Week and a half is enough? Right? It should be. And so we have this identified, price hit it and dropped. Doesn't look like much, does it? But first of all, it's our sell zone, so on and so forth, from analysis that we've already done. It's already been done. Doesn't look like much. I did sell in there. And in fact, on the account history here, I sold at, wait, 109.71, right? 109.71, so basically 110. And I got out for profit at 649, so 106.50 for, I don't know, 300 something pips. Not bad. So that's what that was our plan, guys. We said we would sell it there. Dropped. Doesn't look like much of a drop. Unfortunately, right? I think I had something like a 100 pip stop and a 300 pip limit. Stupid thing. I got my stupid 300 pips. Should have been 900. Well, whatever. That was trade plan, right? Everybody clear on that? Right? Everybody was clear on that? That was actually the trade plan from a week ago, more than a week ago. But it looks obvious now, right? But I haven't touched this chart. I haven't touched this chart in over a week. We've looked at it several times. But this was the last short swing trade we had. Okay. So anyways, that was good. I got two more still open. They've been kind of up and down all night. Pound dollar short. Let's look at that. So the message here is I'm only doing what we said we would do. Okay, so we're back to this one. What chart? Oh, here it is. This looks pretty good, and this makes sense, right? What do you think? Good place to sell? Does anyone understand the logic of selling there? Oh, wait, it's the monthly reversal pivot point. Or sorry, weekly reversal pivot point. But that's the point, right? Isn't it? Isn't that how we use pivot points? Or am I being like a wild and crazy guy? Notice it's also a midpoint cycle level, 5150. How many people look at this chart and understand what I did? I mean, you should be able to even learn from that, right? Yep. Wild and crazy. I mean, think about it. The market was nuts, right? The market freaked out. Oh my gosh, this is such crazy news. The Fed's not going to raise interest. I mean, it's so elementary. It's unbelievably redundant, silly that it's even a conversation. And then the market freaks out. Now, think about it. Who moves the market like this? These are billion-dollar hedge funds that are just have no clue what they're doing. You have an unfair advantage. because of the smart money. There was, right? We have no surprise or shock on the event. And then traded it intelligently based on a trade plans that we had already created. Cool. I can't imagine how $1 billion hedge fund manager would be surprised by yesterday's results. It's just shocking. But anyways, so that one was up almost 300. I think I missed the limit by just, I don't know, whatever. I didn't throw a limit on that one. That's why. All right. And then the other one was not a very good entry. Let's look at a mediocre entry here. I bought at 120, and I wanted to buy again lower, and then I missed my entry and then didn't get another shot that I liked. There's another pivot point down. Let me look at my other computer screen. 50. It's about here. And I had my finger on the trigger, and then I don't know, whatever. So I'm in here. Okay, you can see there. I put it 1 pip or something, 1 or 2 pips above the monthly M3. Can you see it? This is my entry here, right? Just below that is weekly support pivot. And then right in there as well is a psychological level of 120. I don't know. Not the world's greatest trade, but I don't know. Okay, I suppose. So it's up 50 pips now. I don't know. I should have pulled the trigger on the lower one, but whatever. I don't know. It was also a daily 55 if you go farther out. I don't know. It's just one of those things. The way that it was trading, I don't know if you actually traded it live yesterday, but the market would fall, and then it would, seem like it would calm down, right, for like 40 minutes, and then it'd go wham, 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 and I'd look at it like, dude, does that have 75 pips at 1 5-minute candle? Like, holy crap. Mike, I told you not to do that. I don't want you, Mike, you're not following the directions. I don't want you to manage your trades. I want you to follow instructions. Flip a coin, identify support and resistance, buy if you're a bull, sell if you're a bear. If you have to, do a 100 pip stop, 100 pip limit. I don't even care. Right? Our goal isn't for you to be profitable. Our goal is for you to make a decision. I can only do one thing at a time, right? One step at a time. Remember, the analogy I gave you yesterday is, let's say you hired me to teach you how to golf, and you want to hit some balls, man. Where's the driver? Give me the big stick. No. Hold the club in your hand and swing, but don't hit a ball. That's all we're doing right now. Feeling comfortable with the club in your hand and you're holding it properly. That's it. Nothing more, nothing less. No, I didn't ask you to put down a bunch of limit orders. I asked you to make a decision and pull the trigger. So anyways, mediocre trade, could have done better, but you know, I suppose you've done worse on this as well, right? So I still understand why I did it. I kind of missed one down lower, but whatever. Yeah, no, I want you to pull the trigger, Mike. I suppose you could put down a bunch of limit orders, but it sounds like degenerate gambling when you say it that way. Why not? Right? Identify support and resistance on a higher time frame, drop down to a medium time frame, look for per setup, drop into a 5 minute for entry, pull the trigger. What? What do you mean? Mike, I could tell you what I can do tomorrow. That's the strategy. Strategy is easy, right? Pulling the trigger is a timing issue. So that's why we need you to make decisions. So if you're a bull, open up your chart, pick a higher time frame, identify 3 levels of support. That's not hard. Well, it depends, Mike. So Mike says, I'm using a 1 hour to decide, is that enough time to identify support and resistance? Well, I don't know. Not if you're looking at it like, oops, not if you're looking at it like that. Okay. Maybe if you're looking at it like that. So it all depends. You see how I've done it here on the hourly fast? You can see I've identified resistance, right? So that I could sell, sell, sell. Okay. Okay, good. See, I don't care. At this point, you need practice making a decision and then executing the decision. Technology patterns of elephants. Right now, make a decision and carry out the action. That's all that matters. And then we can improve things. Okay? All right. Well, I'm assuming other people are listening to this. So wake up in the morning, flip a coin. If it's heads, you buy the US dollar. If you're higher of the US dollar, you identify support. Give me 3 areas of support where you would like to buy that US dollar. Okay, fine. If you want to use limit orders to enter, that's fine. I'll accept that. You put in your limit orders. You put 100 pip stops and 100 pip limits, right? So use a 100 OCO and be done with it. We'll see how you do. If you're a bear, right? Do the opposite. Cool. Do that for 5 weeks. Okay? Remember, use the OCO. Okay. So that's that. Everyone's invited to do that if you want. I don't care about the trade management stuff at this point because, you know, there's so many other things to worry about, right? It's like you don't go to the doctor and say, you know, I have an ingrown toenail. Can you help me out? And they're like, dude, you have a shotgun wound. You're like bleeding profusely all over the floor. You got guts hanging out of you. Yeah, but it's my toe. My toe's killing me. Well, you know, wow. Right? Doctor's going to have to fix that gunshot wound. Okay, so anyways, so that's that. Who cares? Now what? Let's find. Well, let's go through the world quickly. I like to realign the satellites and stuff. So yesterday was a big day. You could have made 1,000 pips or something. Good, fine. They're not important these days. You know, days like that where the market goes crazy. If anything, they're great opportunities to lose a ton of money. So they're really, on the long run, not that important. The way to be very successful in Forex is the boring way. Every single day, you log in, you do your analysis, identify your support and resistance zones, you buy low, you sell high, it moves nice and slow, gets you for moderate wins or small losses, and rinse and repeat, rinse and repeat, rinse and repeat. That's how you do it. These big days where you make 1,000 pips, I look at it like you made 1,000 pips, you're so lucky you didn't lose 3,000 pips. Or even worse, an amateur trader would do this. Lose 75 pips, but it's worth, 10% of their account. I was trying to get rich. Loser. Loser. So anyways, some gold moved, right? Anti-dollar. We talked about this. That's why we have it at a support zone. Fine. Is it the end of the world? Is the dollar dead? No. But whatever. Our job is to identify the next level of resistance. So, this might be it. That might be the top. Or we can do something like this, head up to 112 again, in which I would just probably bring it down anyways. Because I still can't figure out why you should own gold. 10-year T-note's back below 2.0, so, for now. But if it starts climbing back up, then gold should come down. You can almost look at the yield as the anti-gold, not dollar per se. Okay, a little move in oil. Okay. So again, these are areas to sell. So you had an opportunity to sell around 45, and it's back down to 43. Fine. Okay, a lot of this is knee-jerk reaction to the marketplace, which is fine. But you can see the market's trying to normalize fairly quickly. Be careful. Do you see the reverse fib? Always ask you if you're, what the other traders are doing. So a bull would be getting ready to buy this, right? Isn't that what a bull would want? Head up to here. And the reason this area is interesting is because that's where a bear would, right? Why? About 50% of this, right? So it's like we have all these areas marked up. These are places where bears would sell. And then conversely, right, these are areas that, bulls would buy. So to short now would be silly, right? Because there might be entries here. And you could just take my old analysis, right? This is from yesterday's analysis. Come on now. All right, that one doesn't want to play. Oh, now it wants to play it. Okay, that kind of thing. That could be support now. So too late to sell. But if you were bullish on this, all right, so this is something that Mike could be doing. If you identify this as support because you're a bull and you flipped a coin, the only thing you can do is buy. Well, this is actually a buy zone. It's you're either going to buy it there or you're going to buy it, oops, here, right? Let's do it that way, right? So let's say those are two sort of medium term, whatever. So for me, if I was a bull, I would look at this as a 618. Okay, why? Because it made a higher high. So it's a simple 1, 2, 3 pattern, right? After the higher high, you would predict a higher low. 618 Fibonacci retracement, fine. So you're up in here. Do you pull the trigger now? Well, I don't see any trigger, right? So you check the 15-minute chart now. So we're dropping from a 4-hour to a 15. Okay, what kind of conditions would I want to look for if I was a buyer of this? One, I'd like to see it oversold and trying to rise back up, which it kind of looks like it might be trying to do. I'd like to see a candlestick pattern. Well, how about a double bottom? Okay. Sometimes psychological levels can play a role. Oh, look, it's $43.00 right now. It's a 618 Fibonacci retracement. All right. And I'm a bull because I flipped a coin and not allowed to sell. The only thing I can do is create bullish trade plans. So let's see. It's a 1, 2, 3 reversal pattern on a 4-hour. We've double bottomed at support, which is a psychological level, and a 618 Fibonacci retracement of the high. And we're making a Stokes cycle on a 15, which tells me in the next hour it may turn bullish. So there still might not be a trigger here, but do I get the green light to consider moving forward? Right? Still not necessarily a trigger. Okay. So then you drop into a fiver, 5 minutes here, and see if an opportunity appears. One thing you do is like, here's a double bottom. One way to trade it is higher high, higher low. Oops. Come on, mousy. There we go. Okay. That's one way of trading it. Someone else a little more aggressive is going to want to buy it off the bottom here. You know, a more conservative one is let it break and then catch the retracement. Okay. But if you were a bear and you were trying to sell there, you're slow as molasses on a cold Georgia morning, and your analysis is very pathetic because you're selling at support. You were so bearish you should have shorted yesterday at resistance when the market was mispriced. Okay. Let's take a look at Kitty Cat. How would you mark this chart up? This is a 4-hour. I guess maybe we go to the daily. Yeah, let's go to the daily. Get rid of some of this stuff. Okay, nice clean chart. Beep, beep, beep. Oops, beep. How's that look? Okay. Does it look like it's trending at the moment? Let's zoom in. Notice there's no moving averages or anything. Seems like we're consolidating. Prevailing trend is up. So if I had to bet, if I did have to guess, I'd have to guess in the direction of the prevailing trend. But what you should be doing is, letting it trade and then waiting for the break. Okay. So for example, go to a 4-hour, and that's not a very good entry. That's not a good trade. It's not overbought, it's not oversold, nor is it really making a higher high or a higher low. Okay. So I look at that and I say to myself, what a wonderful trade. But if it breaks to the upside, which I think it has a higher probability of doing, trade it like that. Okay, not buy it here, okay, but buy it here. Okay. Okay. So that's USD kitty cat. Nice little trend though, huh? Didn't know it was going to move that high. For a lot of last year, we were talking about, we bought it in here and the target was like 110. And then I thought it would come down to 1.5 and that was fine. But no, I didn't see this. Holy schnecker schnocker. What a move, baby. It was like, again, if you looked at oil back then, we had this simple thing, sell it at 110, buy it at 80. I didn't think it would drop to 50. 100 seemed too much. 110, 105, too high. But 50? Didn't see that one. Wow. Holy wow. All right. So here's some crazy analysis, right? Higher high, higher low, higher high. Okay. Can you see how, or let's say why price, like you take this low, you take this high. Okay, this could have been a short in here. Maybe not on the spike, but certainly after the spike, if you were a bear. Take the spike here and come across. Price actions in play. I would call this our top though. I'd call this our bottom. And I'd play the range for a while until it breaks one way or the other. Okay. I don't know if it's going to be up or down. That's not my job necessarily. If it, it could do this and I'll react differently. Okay. But the most important thing is analyzing the market and identifying whether you should be a bull or a bear, aggressive or conservative. I mean, you got to read the market, right? And so this is how I read the market, sideways. So I can buy at the bottom, I could sell at the top, or I could just let it go, take a day or two off, let it break, and catch the retracements. Okay. Easy peasy lemon squeezy. Right? So I look at that and I want to be conservative. Okay. So for example, I could sell this up in here, you know, a little bit closer to 180. Okay. So this could be my sell zone. I'd like this to be a little higher than the overbought position. So that would take, 5 or 6 hours from now. So end of trading day today, or maybe Asia or something like that. And then drop into a 15-minute chart. Right? And find it, let's say, up in here, rolling over. And then I can take a short here because I'm at resistance, and my only goal is to, trade it back down to support. Support being this sort of area. Sell at the top, buy at the bottom, right? Range trading. I prefer trending if I had a choice. Sometimes I don't have a choice. A wonderful range. Did you guys trade binaries yesterday instead of spot? So that you don't take a bloodbath if you're wrong? The volatility doesn't kill you? If it spikes 75 pips against you and then came back, you didn't even care? Anybody take opportunity, practice binary trading? That must have been a no. Now think about that. Why not? You're a client of a broker that has, a pretty unique value proposition to you that you can trade in scenarios like we had yesterday with a lot less risk. Sure, you might give up some of the opportunity because you can't make 1,000 pips. Either you're right or wrong, but it'd be a good opportunity to scalp and not have the high volatility risk. Right? But whatever. I would put it on your on your to-do list. Play around with binaries. Apparently there's no demo though, so you're going to need a live account. But yeah. We made some binary trades last week, right? As examples. Here's one of the cash. That was a winner. Where's the bingo stuff? Yeah. What's these ones? Winner, winner, break even. Right? Lost nothing, made 180, made 180. Love. Okay, so what is this? I guess we've already done Euro, right? Let's just look at it on a different chart and see if it still makes sense. You know what? I didn't even see that trend. That's from a long time ago. Wow, that isn't that funny? Whoa, that's from a long time ago. I didn't even have that on my chart. Look at that. Look at, wow. There's the top. Wow. Nice. I love it when it does stuff like that. I get all tingly. Wow, that is sweet. Somebody must have been playing that, huh? Wow. Look how far back I have that trend line. Oh, it's just redrawing it. Maybe that's what it is. It's just coincidence because it redraws it incorrectly. All right, that's fine. Too bad. That's interesting. That looks good there. So one of the things with the pound yen one, I'm not sure if I showed it. There was a monthly pivot just above the wick high, and where price is just below the weekly pivot, and we're right below the hourly 200. So kind of interesting stuff. Maybe bring the pound back down. You have to ask yourself if you're a bull or a bear. If you're a bull, you're actually in a bullish buy zone. So yeah, I think I already covered that. So you got to be careful. Let's see, we did CAD, we did USD yen. How about any requests for technical analysis of a currency pair? Or do you want to look at, like, you know, goofy Fed charts? See, the thing is, we understood that the Fed was not going to raise interest rates. One of the things that is going on here, let me zoom in a little bit. Okay, look, this is actually produced by the Fed. And what's interesting is their longer run growth. Oops, let's get rid of that thing. Their growth projections are getting flatter and flatter. You know, stuff like this going on. So what the Fed is saying in so many words is that the economy is growing and it's becoming more healthy. They're not hitting their inflation targets and stuff. But it's okay. Things are okay, and they're likely to stay okay. Full employment is likely to be less than it used to be. Inflation is probably going to be low for a while. And basically, I think the economy that we have now is going to be around for several years. Oh, thank you, Igor. Remind me when I'm done with this this soliloquy. So they're projecting. At one point, they were projecting that all this QE was going to create a lot of inflation, right? And I'll just draw over the top of our charts. They were hoping like inflation came crashing down, and then it moved sideways, and that it would move like this, like a cup, right? Now what they're thinking is it's going to be like this. Oops, that didn't clear out. Hang on. So according to the new discussions and some of the research provided by the Fed staff, is okay, inflation dropped, then it bottomed out when, you know, and then it's going to be like this for a very long time. So we learned a couple of things. They're not going to raise interest rates. We knew that. I mean, if you just read the report every month, I mean, it's so clear. I don't even know what the discussions are, why the market would be so wrong. They're degenerate gamblers. But anyway, so we knew that they were not going to raise for a while, but eventually they will normalize. That's fine. When they normalize, it's not even that important. It won't have any bearing on, let's say, what I do. I'm a bull for the US dollar. I have been since the day they started the taper. Okay, done. Why? Change in central banking policy. They began to normalize then. Well, they'll continue normalizing when they think about raising interest rates, and then they'll continue normalizing when they confirm they're going to raise interest rates, and then they're going to continue normalizing when they raise interest rates. It doesn't matter to me what date. Who cares what date? And then the next thing is how fast are they going? The velocity of normalization and the periodicity. Every meeting, are they going to raise it a quarter point? Is it every meeting they're going to do a half a point? All that kind of stuff. And the real question is, to what level will they raise interest rates? Okay? And the day they tell us that they are going to stop raising interest rates is the day I become a bear. So I don't really care like when. Is it the June meeting? Is it the October meeting? Who cares? Who cares? It has no bearing. Whatever. Because you can model all these things and stuff. It doesn't matter. It's the policy that matters. Change in policy. And there won't be a change in policy for a long time. Raising interest rates isn't a change in policy per se. We're normalizing. That's the only thing I care about right now. But what we did learn is that if thinking at some point that, let's say, 2.5% would be where they would get interest rates, right? Fed funds rate, through manipulating things like the discount window and such. If they thought it was going to be 2.5%, what they're probably thinking now is it'll be 2%. Whatever, right? And it's the part that I'm talking about now that's changed is this part highlighted in yellow, that they used to think it was going to be steeper. Let's say, not necessarily the velocity, like the rate of which they raise interest rates, but maybe like steeper to the point of where the interest rates will rise to. And now it's flattening out. And probably my guess is the velocity has changed a bit from getting it to 2.5% in, I don't know, throw out a number, 18 months. Right? And let's say it's not 18 months now, it's 24 months. So their reach, let's say their target is a little lower. They're going to give themselves even more time to get there, so on and so forth. And like Yellen said, because she's removed patient doesn't mean she's impatient. Okay? Which to me is fine. All I learned yesterday is I'm still a bull, and I'm going to be bull probably for longer. Okay? So what I looked at yesterday was yesterday's report side by side with the previous report, and just simply looked at what they changed. But so there, everyone's worried about patient. I don't know who made that up. Who cares? Seriously, it was like one of the newspapers, probably Reuters. Some guy that makes $40,000 a year writing for Reuters probably said the most important thing to look for is patient. Is the Fed still patient? And then that gets covered by every newspaper and every TV show about finance around the world, because none of these organizations can afford to have an analyst actually do their own research and say something intelligent. So everyone's like, patient, 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 patient. I'm telling you, it's so silly. It doesn't matter. What matters is, where what the level of normalization is, and the velocity to get there, and all that kind of stuff is fine and dandy. But it's the change in actual policy that matters. And right now, we're normalizing raising interest rates, normalizing, and all that kind of stuff. And so all I learned is I still think they're not going to raise interest rates. I have my doubts that they'll raise interest rates this year. So now they're going to tell you, June's going to be the day, June's going to be the day. And then they're not going to raise in June. And then October, the Fed's going to have to, right? They're going to have to raise in October. And then the TV shows, will come out and they'll do their polls and they'll talk to all the professional investors and the floor traders and hedge fund managers and mutual fund managers. And they'll tell you that there's a huge percentage that the Fed just has to raise interest rates in October. They did this during the taper. I remember when everyone thought they were going to taper, I was telling people that there was no chance in hell they were going to taper at that meeting. And I was watching CNBC right before the announcement, and they had a guy that was on the floor of the New York Stock Exchange before the announcement came out, and he walked around and he said, I talked to every floor trader here on the New York Stock Exchange, and every single trader said they are going to taper today. They're going to announce the taper. It was 100% response rate. And I was so shocked. I'm like, if you just listen to what, at that time, Bernanke, right? And if just read the minutes and listen to his speeches. I mean, there's no way he actually said he's not going to do it. Like, where does this come from? And sure enough, the world was shocked. They'd taper at that meeting. Just amazing to me. So they're going to freak out, and Bloomberg and CNBC and Financial Times, Investor Business Daily, Wall Street Journal, they're all going to tell you, oh, well, it has to be the October meeting. You know what? It's probably going to be March 2016. So this is why you need to, first of all, learn fundamental analysis and understand it, guys. And then lastly, do it yourself, because the market of professionals and the writers at the media, they're not going to take care of you. They're not going to take care of your family. They just want ratings and they want to sell copies. You're going to have to do it yourself, right? Like I did. Look at yesterday's announcement, right? Just, you can get it word for word and put it right next to the one before. See what has changed. Analyze it and make a decision. What did the Fed say? The Fed told us they're not going to raise interest rates. Maybe not even this year. And when they do, the slope and velocity is going to be flatter. Maybe, what? Stagflation. But stagflation is high inflation levels and low growth. Well, I don't know what the word would be. It'd be low growth, but growth. And some sort of inflation, but not high inflation. But if I like that, I suppose as an economist, you could get some better. As a trader that understands economics, in particular global macroeconomics and stuff, it makes me think of a carry trade. And I'm sorry I'm going on much longer speech, but this is important. If you are carry trading, no, let me ask somebody, let's ask the group here. How many people have had a trade that was over 1,000 pips and you're still holding the trade open? You're plus 1,000, plus 1,300, plus 1,500 pips. Right? Anybody? It used to be a common thing. I used to teach this all the time. We used to kind of celebrate people's first 1,000 pip trade. It used to be a thing. So again, the only reason you haven't done it is A, maybe the market's changed a little bit, but you're not even trying to do it. Right? Yeah, well, of course, Aaron, right? Yen crosses it. Yeah. But it used to be a very normal thing. People had to tell you that that's what you should be doing, and then you should try doing it, and then you're like, oh my God, I never thought this was possible, but now you can. Right? Roger Bannister running a 3-minute mile. No one could do it until he did it, and then everybody did it. So anyways, if you're in a situation like this, and what we're talking about now is a carry trade, you're not in it for the pips, you're in it for the yield carry. That's why they call it a carry trade. So for example, there was a time when you paid 0.5% to borrow Japanese yen, and if you put it into a Kiwi, it paid you 8.5%. So that the yield differential cost you you borrowed the money for 0.5%, and then your investment paid you 8%, or sorry, 8.5%. The yield differential was a full 8%, guys. 8%. Now remember, in Forex, you get paid on the amount you've borrowed. So let's say, let's say $1,000 buys you a standard lot, right? And a standard lot is $100,000. And you put it into something, you get paid on the $100,000. You get it? You might only have $1,000 of your own money. You're collecting interest on a $100,000 investment. Is that a big deal? Well, if your yield differential is 8%, what percentage, sort of in real terms, if you will, are you collecting $1,000? You're leveraged 100 to 1, Daniel. At that time. Actually, at that time, people are getting more. Okay? Huge money, guys. So you make the investment so that you can collect these ridiculous sums of 3, 4, 5, 6, 7, 800% on the yield alone. Okay? So you start making carry trades. The problem is the pips are worth a lot of money. So you start getting in these trades, but if your carry trade suddenly skyrockets and jumps 300 or 400 pips or 500 pips in a week, because think about it, the daily range on a lot of these yen pairs are well over 100 pips, right? So you could make 600 pips in a week doing nothing, just being long and holding it. And it could go up for 3 weeks straight. I mean, 1,000 pips could be a month. So anyways, if it moves too quickly, suddenly you're up 1,000 pips and you're sweating bullets because yes, you're collecting this huge yield that got you in the trade in the first place, and that was the whole point and the whole strategy was so you could collect this yield. But unfortunately, you've made so much money quickly, pip-wise, that it would be like 6 months worth of yield carry, and it messes up your strategies and you panic. Okay? And you can't sleep at night because you're like, it's going to retrace, it's going to retrace. I got to get out, I got to get out, I got to get out. Well, if you don't get out, you're just going to collect 800% a year in interest, right? On your $1,000. You're just collecting all this money, and it's, and your stop's at break even, so you can't possibly lose, but you can't sleep at night because you're worried about it, it coming down 200 or 300 or 400 pips in the course of a few days, and you give up all that money. So you can't sleep at night, can't sleep at night. I have to get out, I have to get out, I have to get out. And all of a sudden you wake up at 3:30 in the morning and go down to your office and you get out of a perfectly good trade that is moving wonderfully, and you're getting paid this huge yield, but you just can't bear the pain of how much money you've been making on the trade. And you cut out. Same thing like when let me reverse that now. When you're carry trading, what you want is slow and steady growth. Just slowly making pips. It's moving up every day, but not too quickly. There's not much volatility. It doesn't go up 300 pips one day, down 200 pips the next. Just slow, steady trend, just over the course of the year, just keeps going up, and every 7 days a week, you're collecting interest, a huge amount of interest, and you're just loving it. That's what you want. And now, as a trader / economist, I'm thinking about, well, that's the kind of economy that we might want, right? If the Fed is going to continue this sort of normalization, and it takes them 3 years to get interest rates to 2.5%, then I'm going to be a bull for 3 more years. And that I'm fine by that. That means the stock market's going to go up for another 3 years. I'm fine by that. So on and so forth. Okay? Hopefully, we'll see the bond market correct. And that's what we want. And there's big money there, too. Big money there. So I think it's going to be good. So all this stuff where people are freaking out, it's just because they're not looking at the facts and analyzing it and making a decision. But that's what we do, and that's why we're smart money. Let's round up with the Aussie dollar. Okay. Okay. The top of this market was 78.50. Let's see. Oh, we already had it marked up. Hoo-ha. It was also essentially our old 382, but not quite, because I haven't adjusted the fib. So let's adjust the fib, because we had this lined up like a month ago. So let's see what happens here. Now that we go to the low that occurred a few days ago, check it out, guys. Here's what the Aussie dollar did. Up to the 382, down. Pretty complicated stuff, right? It made a 3.8 Fibonacci retracement. Now let me ask you something, Bear. Could you have had that set up ready to go? So if you didn't sell it, it's because you didn't have it set up, you were not ready to go, and maybe because you didn't make the decision of being a bear in the first place. Right? Look at that once I adjust to the top here. It's so beautiful. Look at that. It's actually to the pip, isn't it? Oh, yeah, it's to the pip. Okay. So it's one of these things, guys. You're trading, a lot of traders think they're not using the right tools. They don't have the moving averages, and some use simple moving averages and others use exponential, and then there's all kinds of variations of them. And maybe you're not using the right one. Maybe it should be a 50 EMA and a 200 SMA, and you just don't have the right combinations, right? And then maybe you use oscillators, but you want ADX over the MACD or something, or maybe you use ADX, but you think you should use MACD. All of that is nonsense. what usually holds back, and I say usually, 99.9% of the time, what holds back a trader from success is that they don't make a decision ahead of time. Right? That's it. If you're a bear, you should have shorted that. That's it. And you could have, and it wasn't even complicated. Now you get caught up in the moment, and the market's freaking out and stuff like that. That does add a degree of challenge to it. But at the end of the day, even when the market freaked out, it acted very logically. So who was freaking out then? Look, that's how precise it was when the market was quote unquote freaking out. Right? So if you're a bear, you on the Aussie dollar, you would identify 3 levels of resistance of which to sell. This should have been one of them. And it was sellable. Okay, looks like my pound dollar short back to 300 pips profit from yesterday. And that was a trade up 2 weeks ago. Very similar to this Aussie trade, right? Not complicated at all. So what's complicating things? Maybe it's us, right? So again, on the daily chart, does it look like a bullish trend or a bearish trend? Yeah. So now you do the far peak to valley analysis, right? It's this one I'm looking at. Okay, high, low, 382, right? Notice I have another trade plan ready to go up here. If it comes up here, I'm going to try to sell it up there as well. Okay, I'm already set up. So like I said to Mike, I'm like, Mike, I can tell you what I'm going to do tomorrow. I mean, you just create the plans, right? So right now, this might be tomorrow, might be next week, it might be next month. If price comes up this upper gray zone, I'm going to look to sell it. It's easy. Why? I've made a decision. I just don't know when or if it goes up there, but if it is, I'll tell you what I'm going to look for. I'm going to drop into a small time frame, look for weakness, and I'm going to sell it hard. Right? Nice. So it's been a long session, I think about an hour and 15 minutes or so. So I guess I better pull the plug, but I just like hanging with you guys. Thank you for being on my team. Thank you for being a client of tradersway.com. As always, I'll upload this to YouTube so that if you do miss a session, that you'll always have an archive at your availability. Please give it a like, please subscribe, and please leave a comment. And if you do leave a comment, I'll try to respond within 24 hours. Also, tomorrow is Friday. Every Friday I do these strategy sessions at fxstreet.com. So namaste, peace on earth, may the pips be with you, may your profits be above average. Trade your way, a trader's way with Traders Wayne.